Good morning, all. Let's start with the morning call. Uh, Nifty gained another 1% last week, posting fresh high last week, leading the major global market. Earning sentiment is continue to improve across most sector ahead of the result season. FII buying remained strong, nearly $0.9 billion week-on-week basis, and it has surpassed DIS flows for year till date, where FII flow stands nearly $12 billion against the DIS flows inflows of nearly $10 billion. While we like India's structurally, we expect Indian market to bit consolidate in the current quarter and with the better performance going in the next quarter, which heads into the festive season. We favor domestic cyclicals, and we also like banks, industrial cement, and insurance space. On actionable ideas front, two actionable ideas. First is Zomato. Given the Swiggy food delivery GOV was nearly $2.6 billion in calendar year 22 versus Zomato stands at $3.2 billion dollar. This is against the $2.1 billion and $2.4 billion respectively seen in calendar year 21, which indicate that there is a market share gain for the Zomato. Zomato is outperforming Swiggy on GOV growth and profit basis. Going ahead, seasonality, Indian Premier League, which happened, and market share gain is expected to drive the strong growth for the first quarter 24. While the management has also guided for the high single-digit sequential growth for the business in the first quarter FY 24. Second is Infosys. We also like Infosys given its valuation, which now trades in attractive nearly 20 times price to earning, which is nearly in line with its 10-year average level. Infosys has already announced 4 to 5 deal wins in the first quarter and has a good mega deal pipeline with some of the deals which are in the advanced stages. We believe the soft revenue growth for the FY 24 is already factored in the current stock price, and any announcement of the mega deals win will potentially help the stock to re-rate from these levels. Two stocks will be focused going ahead. First is the Reliance Industries, as the Reliance Industries has announced that it two step down subsidiary, that is the Reliance Retail RRL, owned by 99.93 by Reliance subsidiary Reliance Retail Venture RRVL, which is in turn 85% owned by Reliance, would buy back the non-promoter owned share at around 1362 per share. The fair value of RRR determined by the two independent valuer is nearly around 850 to 900 rupees per share. Hence, the implied valuation of Reliance Retail uh, is nearly at around 8,600 billion rupees, or nearly $105 billion, given the RR VL EBITDA is nearly 2 to 4% higher than Reliance Retail, as it has also few other investment asset apart from Reliance Retail. We view this as a positive development for two reasons. First is the implied diluted valuation and independent valuation are all in excess of $90 billion and sharply higher than the implied equity value at which the stake was sold to RRVL back in 2020. In our view, the buyback of the small numbers of non-promoter share is effectively a cleanup of the shareholding before any eventually IPO for the retail. We remain positive on the Reliance, as we believe that the net debt concern is overdone, and also because the RIL has industry leading capabilities across the business, which is expected to drive the robust 14 to 15% EPS CAGR over next 3 to 5 years. United Spirits will also be in focus as on Friday, the Karnataka government has raised the taxes on the spirits by nearly 20% in its budget, while we see the tax hike resulting into sharp hits on sales. That said, we worry about this setting if precedents of the other states also using the liquor taxes to fund the election promises. Such risk, along with the input cost inflation and execution risk associated with the uh, renovation, remains a concern to the EPS growth. That's all what I have. I will stop here and hand over for further update. Thank you.
Thanks, Kaushik, for that update. Very good morning, friends. This is Rahul Sharma this side from the Technical and Derivatives Research Team. Now, FIs have bought equities worth rupees 72,000 crores in the last 4 months since the markets turned around from the month from March ending. But this is a relatively smaller number as compared to the outflow that we've seen in the last year, which has been close to around 3.5 lakh crores. So we believe that this figures, the FII flow should continue, considering the fact that the worst may be behind us, especially in terms of the inflation for the US. Now, what that translates into is continued inflows into the emerging markets, which means that the cash figures should continue to stay upbeat for Indian markets, which should bode well for the Nifty's uptrend. Now, if we specifically see what happened last week, Nifty like made a high of new all-time high of 19,500 plus. This was backed by FI by which pumped in around rupees 9,165 crores, whereas DIs were seen booking profits as they were the ones buying when the Nifty was going down. Now, everybody to keep their attention. Okay, so coming back to the market view. So FIs added longs in index futures for most part of the week previously, and retails have been seen stuck in the short positions. Now, the FI index longs had touched the highest mark in 12 months at around 1 lakh 2,028 contracts on Thursday, was its previous high of around 1 lakh 2,664 contracts, which was seen in November 30th November 22. So clearly, it has been a strong inflow into the cash segment in the week, along with continued buying in the index futures, which has kept the market upbeat into like and Nifty registered a new all-time high. Now, week on week, the combined open interest has gone up for all the indices like Nifty, Bank Nifty, Fin Nifty, and Midcap Nifty. While can we please keep the lines on mute or the candidate person will be from the meeting? Okay, so coming back, the combined open interest week on week has gone up for all the indices, but the put call ratio has cooled off significantly, indicating that we are not as overbought as probably what we were on in last week. Now, autos were the star performer last week, while PSU banks and Bajaj Twins saw the bulk of the buying action in the Nifty 50 space. Chemicals and infrastructure saw some selling pressure. Now, going into this week, the view is Nifty is expected to extend the cool off down to 19,200, 18,900 zones. It has formed an inverted hammer or a shooting star candlestick pattern on the weekly charts, which means a bit of downside can be expected. But we believe that this could be a good buying opportunity as Nifty, as a retest of this breakout of 18,900 will be positive for the overall trend. And that would mean that a lot of money which has been waiting on the sidelines will get an opportunity to re-enter to enter into the markets. Okay, so on the stock specific front, there are a few names which look very good from especially the bargain stocks like HDFC Bank. Now, this stock has seen a correction from the extraordinary move that we saw a few days back. 1647 is a very good support for the stock, or a good value entry point for the stock, where the stop loss can be had at 1600, and we believe that the stock can rebound from these levels to go in the next move up till 1800 on the upside. So HDFC Bank can be bought at around 1650 odd levels. Eicher Motors, we feel that it has more or less factored in the negative news about the competition. So it has. There were two updates. One was the Harley Davidson, and second one was the Triumph launching its affordable bike. So we will, given the stock's reaction, most of this is factored in. And those who missed the rally in the stock, I think around 3185, the risk reward is very favorable for fresh longs onto this one. So ISIL can be considered for value hunters, or bargain buyers, especially in such a market. It is available below its 200-day moving average. Now, coming to trust stocks, stocks which have high momentum, PSU Bank saw very good action on Friday session in spite of the broader market remaining under pressure. We saw SBI holding its line. We saw Canara Bank doing extremely well. Bank of Baroda, in which we have an open recommendation, uh, made a new high at 209. We continue to remain positive on this one, as we have also circulated in the report. One can expect a target of 229 on the upside, which is the previous all-time high. And above that, we could very well see the stock heading towards 250 by the end of this year. So, momentum traders can keep an eye on PSU Bank stocks. On the short side, it is UPL, which is the weakest of the lot in the Nifty 50 space. So, this stock continues to remain bearish, and momentum traders can look at it. Reliance is another one which has done well, and we have had multiple long recommendations in the same. Uh, from a momentum perspective, this stock can extend its gains up to 2750, and otherwise also we are expecting 2800 to 3000 being tested in Reliance in the medium term. So Reliance can be traded with a positive bias above the 2590 mark, and we feel 2750 is very much on the cards in the same. Now, this should also limit the Nifty's downside. If this week we are expecting a bit of pullback in the broader markets, Reliance could actually play the savior, and Nifty may find support either at 19200 or 18900, which is where the two key Fibonacci levels are placed. Now, going to the macro view, we feel that, why we feel that this could be a good buying opportunity is because 32 out of 50 Nifty stocks are yet to create new life highs. In fact, they are yet to fire. And secondly, FIs are still, by far the most optimistic in index futures. So a combination of these two, which is A, participation, and B is institutional buying happening, especially in the large cap names, we feel that there is more upside to be had going into the next few months of the market. So maybe around 19,000 one can look to add for an immediate target of 20,000 by the end of next month. So by August we can expect 20,000 in the Nifty, and more importantly, Nifty seems to be on the track to achieve our target of 21,000 by year end. So net we expect, considering the way the SGX, or beg your pardon, the GIFT Nifty is indicating we may have a slightly negative start to the day, but overall we feel that the dip, if it happens in this week, could be a good buying opportunity. So that's it from my side. I'll hand over the call to the next speaker for further updates. Thank you.
Thank you, Rahul. Good morning, all. Jai this side for the currency and commodity update. Due to the unimpressive U.S. job report, we had seen a massive sell-off in the dollar index. The dollar index corrected by around 0.8% on Friday. The U.S. economy added jobs at a slower than anticipated pace in June, as the non-farm payroll rose by 209,000 last month. Uh, the market was expecting a figure to increase by 225,000. The US unemployment rate decreased from 3.7% to 3.6% in June, and the average hourly earning remained unchanged at 0.4%, which is above the market expectation of 0.3%. Uh, Dollar index witnessed a decent corrective move on Friday. However, the US bond yields of 10 years remained above 4%. Considering the overall scenario, it seems that the dollar index is expected to move in a range of 101.90 to 103 level in coming couple of days, and we can see a small pullback move in the dollar index. But overall, the structure seems to be a range bound structure. USD INR remained at the high level on Friday and ended the day around 82.80 levels. However, after a corrective move in the dollar index on Friday, we can see a soft opening in USD INR in today's trading day. From last few months, USD INR is struggling to cross the 83 mark, and right now also around 83 levels, near to 83 levels, we are witnessing a bit of selling pressure in the offshore market. So there is a possibility that we can see a bit of corrective move in today's trading day. However, the overall structure is still positive, and there is no major sign of reversal as of now on the chart until and unless the USD INR future holds above 82.55 levels. Traders are advised to trade with a positive bias, and on the upside, we can see a move of around 82.90 levels. While below 82.55, the reversal, the initial sign of reversal would be there, and in such a scenario, a corrective move of around 82.20 cannot be ruled out. So it is an important juncture right now, and it would be like a wait and watch approach one should follow in the USD INR futures. On the commodity side, crude witnessed a decent bounce back from the lower levels, and it continued the positive momentum for fourth consecutive day. On week basis, it rallied by 4.5% and hovering around its major hurdle, or I can say a major breakout level. If it crosses 6,100 in that scenario, we can see a move up to around 6,360, and thus the traders shall trade with a positive bias. And there can be two trading actionable ideas in crude oil. One, either buy above 6,100 level with a stop loss of 6,000, and on the upside 6,300 would be target, or else one should wait for a dip up to around 5,950 levels to initiate a fresh long positions with a stop loss of 5,870, and target would be 6,100. So in either a case, either it's a buy on dip or it's a buy above a breakout level. But certainly it's not a buy at current level, since the risk reward won't be much favorable for the fresh long. On the precious metals part, both gold and silver witnessed a buying momentum from the lower levels on back of a corrective move in the dollar index after the US job reports. Gold gained by around two-thirds of a percent, and looking at the overall structure, it may bounce further towards 59,200 levels. On the downside, support can be seen around 58,400, while the silver rallied by near the 1,000 point on Friday, and on week basis also, it managed to end the week with a gain of nearly 2%. Looking at the overall structure, silver may bounce up to around 72,300 levels, while on the downside, 69,900 would be the crucial support. So both the precious metal can be tradable on the for the buy side on the dips, and use the intraday dip as a buying opportunity. That's it from the currency and commodity side. Now we are open for Q&A.